Okay, so welcome to this Prezi on sources of finance for established businesses. Hopefully by now you've done all the work on small business finance. We're now moving on to look at larger businesses and starting off by actually considering the reasons why established businesses need more finance. Okay, and the simple answer to that is to allow them to grow more. But in what ways? Well, there's three main ways you need to consider. Okay, firstly, okay, new products. Okay, Apple, renowned for bringing out new products all the time. That takes money. That research, that time in R&D, research and development, is really something that's going to cost money for the company in terms of people and also actual physical resources. So that's one thing. Actually developing new products is one way to grow and a reason why finance is needed. Secondly, sometimes it involves actually updating your production methods. Maybe the business wants to move to a new building. Maybe it actually wants to install machinery to allow it to produce much more in a shorter space of time. So you've got the example here of BMW and their motorcycle factory, where they're actually then it's highly automated. That's going to cost a lot of money, but it doesn't have to be something as high tech as that. It could be just actually to buy some new machinery or to move to new premises. Final reason, okay, or final way of actually running it is just through marketing campaigns. Maybe you actually want to launch something and you need to let people know what's going on there. Perhaps the company's going from regional to nationwide, and so it needs to spread the word about it. So a marketing campaign will require some form of finance to actually keep that going. So it's all about growth, but actually there are several ways in which you can bear in mind. Now, all of the work that we've got on here is in pages 177 to your book of your book to about 184. So make sure you're reading on that. It covers all the stuff that you've done on sources of finance on small businesses, and those sources of finance for small businesses are just as applicable to large businesses and growing businesses. So you're still looking at the owner's own savings, perhaps if they've actually got that. That could be an option. Taking out mortgages and bank loans, and so therefore those aspects of small business finance will work just as well here. But there are some variations. Obviously, with an established company with a bit of a track record behind it, then they're more likely to be able to negotiate perhaps lower rates of interest on some of those loans. They may also have some assets, which we'll talk about in a little bit, that they can use to actually secure finance from banks through actually providing some collateral, so there's less risk to the bank. So all of those aspects, overdrafts, everything, that applies just as well as it did in sources of finance, with some key differences. Okay, so retain profit. Okay, if a business has been going for a while, then they've hopefully been making profits during that time. And a sensible business will actually use that as an internal source of finance. That profit belongs to the shareholders. But the shareholders also want to see the company grow, and so they're therefore likely to be happy with the management of that company to actually use that profit and reinvest it in the business. Now, quite a lot of small business owners will do this anyway. They will actually sell something, make a profit, and reinvest that to help it grow. That happens on a larger scale with bigger businesses, but certainly if you become a private limited or public limited company, you tend to need to have the say-so of the shareholders to actually make sure that you can actually do that. So we see here perhaps a vast majority of the money will get paid out in a dividend to the shareholders, and a segment of that will actually be held back to actually reinvest in the business. But it does depend on the nature of the project that's planned. But retained profit is a great way of using it because actually it doesn't cost you anything. It belongs to the shareholders, but they're willing to lend that to the company on a temporary basis in the hope of bigger profits in the future. So, retain profit. Assets. Okay, well, assets are things that the company have which are worth money. Okay, because buildings, machines, okay, trademarks, okay, intellectual property such as perhaps they've got some, a band will have music which they trade, and that can be sold. It may be a case that actually the business wants to move to bigger premises, and they decide to sell off their current premises and use that money to help finance the new premises that they're actually moving into. It could be a piece of machinery they no longer need anymore. Okay, there's a number of different things. An old vehicle that they can get some money for. Those selling off those assets is a way of actually raising finance. And the key thing that happened recently is Vodafone has announced that it's selling its joint venture in American telecoms to a company called Verizon, and they're selling that for £85 billion. Okay, approximately. That's quite a lot of money. So therefore, they're raising that money. Some of that's going to go back to the shareholders, but they're going to hold on to that and some of that and reinvest in their business to grow in other markets. But selling assets doesn't have to be that extreme. It could be a case they actually move to looking at some smaller assets which they sell off, which they no longer need. You've got also this concept of sale and leaseback, and this diagram here shows the seller, okay, selling a vehicle to the buyer, okay, and that buyer is going to lend it back to the seller and charge them a fee on a weekly or a monthly basis. So what the seller gets then is a influx of cash. They get some money for the asset they're actually selling off, and then they actually borrow it back because they still need it in this case. But it can be used to help with financing different projects if they want to do it. Now, there is a problem with this, that if you actually are leasing something generally over the period of time, it may well cost you a little bit more. But the upside is it may be the case that actually the lender, the lessor, okay, needs to actually maintain that vehicle, maintain that item, and be responsible for that. But it does depend on the contract. So you've got this sale and leaseback idea where the company can actually sell the assets but still use them again because they borrowed them back. Finally, share capital. Okay, now this really does depend on the type of business ownership you've got going. We've talked about that in the past, but this will depend on how the company is set up in terms of whether it's a private limited or a public limited company. Private limited companies can sell shares to people that they invite that have shown an interest. They generally need the agreement of the board, of the majority of shareholders to actually do that. And it's a great way of bringing in some extra finance. So you've seen things like that happen on the Dragon's Den perhaps, where they've actually sold some of their business to actually generate some extra capital coming into that business. And that the Dragons then become a shareholder. So quite common with venture capitalists and angel investors on sort of quite young companies that are growing. But also companies can actually sell their shares on the stock market and become a public limited company. And that means that anyone can buy those shares. Generally, they're bought by a number of insurance and banks and insurance companies and banks to actually invest in, but also they can be bought by individuals such as you and me. That generally is looking to raise several £1,000,000. Okay, you're looking at that being quite expensive because they have to hire lawyers, they have to hire accountants, they also have to get merchant banks involved who will actually specialise in helping them to sell those shares and get the money into their business. Downside is you actually do lose a little bit of your own ownership of the company if you sell off that share capital, but it can produce a massive boost in cash to the business to allow it to carry out the projects that it wants to carry out. There are alternatives to just going on the main stock market. There is an alternative investment market that can be you can float shares on, which is generally a nice option for smaller companies that don't want to raise quite so much money for their business or face the cost of being on the full stock market. Now, they're the main ones that you've actually got there. You've got a nice table in your textbook on page 182 at the top with the advantages and disadvantages of others. There are other sources of finance out there. I mentioned venture capitalists, I mentioned angel investors, their options there. But the question then starts to be, well, once you know about those sources of finance and the ones we've covered for small businesses, which one do you choose? And pretty much that depends on a number of factors. It depends on the profitability of the business. Because if a business is very profitable, maybe it's got an awful lot of retained capital it can use, which is quite cheap, and will save it actually going out to other people to actually try and find the money. Alternatively, profits could be reassuring to banks that they're going to get their money paid back, or that they're actually to potential investors that it's going to be a worthwhile investment for them. So profitability can actually help in raising finance as well. What assets does the company have? If it has lots of assets, then gives it a lot of capital, a lot of security to put up for loan capital, to borrow money from banks, because then the bank knows there's some security there which they can sell to get the money back if the business doesn't manage to pay them back in total for the loan. So that's one aspect of assets. You also can think about the fact that if there's a lot of assets there, maybe the company could consider sale and leaseback, or just selling those assets if it no longer needs them, so that it can actually raise some finance. Past history and future prospects are really quite key. You want to look at how the company has done in the past and what it's likely to do in the future, if you are somebody that's going to invest in it, or someone that's going to lend the money as a bank or building society to actually sort of grow. Because if they've got a bad track record, it may make you think they're a bigger risk, and that will affect the interest rate that you will charge the company. So companies may find that with a poor track record, they may end up paying more for any loans that they've got and struggle to actually take on investors, or the investors will want a bigger share of their business, just like the dragons do. The legal structure, as I mentioned, is key. Private limited companies can only sell shares to people that have expressed an interest and have been invited to do, whereas a public limited company has access to everyone, and therefore that can actually allow them to actually generate a much bigger influx of share capital. Okay. Finally, the amount of money you actually need is going to be really quite key to the business. If they need lots and lots and lots, then you're going to look for something that's more like floating on the stock market. If it's smaller amounts, maybe that can be coped for by actually retained profit or through the use of sale and leaseback. But it will depend on what you're actually doing with those assets. Generally, okay, you'll want to try and match short-term funding, okay, with short-term projects, and long-term funding with long-term projects. So share capital is really a long-term item. A mortgage would be a long-term item. So it really does depend on what you're doing with that money, and how you're actually going to be able to finance that through the different options. And quite often there'll be a combination of options that are used for any project. Finally, in your textbooks, you've got a number of different business insight sections which are well worth a look at, and we're also going to go through that using data exercise, which is on page 181 of your textbook in the lessons. So take a look at that. In the meantime, make some notes on what I've said, go through your books, pick out some items there, and feel free to actually have a search on the internet for different sources of finance that businesses can use.